press the bell icon on the YouTube app and never miss another update.
We are discussing a point which is actually a part of Ind AS 34. Ind AS 34 deals with interim financial reporting. By interim period, we mean a period which is shorter than the full accounting year. For example, if a company is following the financial year as its accounting year, then we know that the year will end on 31st March. But if you are preparing any report which is for a period shorter than 12 months, then we can call that as an interim period. For that interim period, you will have to calculate the tax expense. Now, how that tax expense should be determined, that point is there in Ind AS 34, but the computation of current tax, the computation of deferred tax, that is actually a part of Ind AS 12. So that is the reason, although this is a point of Ind AS 34, we are discussing it along with Ind AS 12. Since right now we know how to calculate current tax, right now we know how to calculate deferred tax, it makes sense to understand this point of Ind AS 34 at this stage itself. I don't want to take the risk that I do Ind AS 34 later, and by the time we reach Ind AS 34, you have forgotten everything about Ind AS 12. So that is something which is very much possible, and that is the reason I wish that although it is a point of Ind AS 34, we cover it along with Ind AS 12. So, finally, if you are preparing a report which is shorter than the full accounting year, for example, in India, it is compulsory for every listed company to disclose its quarterly results. Now, when you are disclosing your quarterly result, you will have to calculate the tax expense also for that quarter. So, how am I going to calculate it for that particular quarter? Don't think in this way that every quarter I will find out what is my taxable income and then I will find out what is the current tax on it. That can never be done. Taxation is always done on annualized basis. We never calculate income tax on a particular quarter. You may argue that, come on, we do pay advance tax every quarter, isn't it? So aren't we doing a calculation every quarter? The answer is no. Even when we are calculating advance tax, we first try to project what will be the total taxable income. And on the basis of that, you will then pay the advance tax. You will never do it in this way that, okay, a quarter has ended, so find out how much sales is there. Okay, from that deduct what are the expenses. Okay, now how much tax I'll have to pay on it. No, that is not the way it is done. So there is a certain method by which we are supposed to work out the tax expense. The write-up is there in our books. We can just go through it. It's a very simple calculation that we are supposed to do based on projections. Number one, you should do a projection of what will be your full accounting year's profit before tax. Number two, you should then make a projection of what is your expected total taxable income for the year. On that taxable income, how much current tax will be there? On that taxable income, how much deferred tax will be there? We know current tax plus deferred tax is your tax expense. Whatever tax expense that you are getting, you should work out a weighted average tax rate for the same. And that weighted average tax rate will be used for the purpose of computing the deferred taxes for the interim period. That weighted average rate will be used for calculating the current tax as well as the tax expense for the interim period. If you see the write-up, it's there very much on page 108. It says, estimate the annual accounting PBT considering all future transactions expected to occur. So first make a projection of the full year accounting profit before tax. Second step, compute the annual taxable income considering all the future deductions and exemptions that will be available. So do a projection for the whole year. And three, as you can see, income tax expense is recognized in each interim period based on the best estimate of weighted average annual tax rate. So find out what is the weighted average annual tax rate and then apply it to every interim period. And for all the interim periods, you will be in a position to get what shall be the tax expense. So these are the three steps that has to be applied, and you can work out the tax expense for the interim period. Yes, this discussion will make better sense if we are getting some figures. So we can solve question 17, and then how exactly we calculate the tax expense for interim period will become that much clearer to you. In question 17, we have company A, which is expecting to earn 15,000 rupees pre-tax profit each quarter and has a corporate tax slab of 20% on the first 20,000 of annual earnings and 40% on all the additional earnings. Actual earnings match expectations. They are saying calculate the amount of income tax to be shown in each quarter. So we are supposed to work out how much tax expense should be there in every quarter. Yes. What is the first step? First step, we should find out what will be our annual accounting profit before tax. See, we are expected to earn 15,000 every quarter. So I can say 15,000 into 4, it will turn out to be 60,000. So that is my first step over here as a part of solution of question 17. We say expected annual profit before tax is 15,000 into 4, which turns out to be 60,000. Yes, they have not given us anything about the taxable income, so we will assume that the taxable income also turns out to be 60,000 because they are clarifying actual earnings match expectations. So your taxable income will also turn out to be 60,000 rupees. So I say expected current tax. There are two slabs which they have given. On the first 20,000, you have to pay 20%. And on the balance earnings, you are supposed to pay 40%. So that will be 4 and 16. It turns out to be rupees 20,000. So the current tax is expected to be 60,000. Now we have to work out the weighted average tax rate. So I say weighted average tax rate equals to, you are going to pay total tax of 20,000. So I will take 20,000 over here and I will divide this by your accounting profit. Your accounting profit is expected to be 60,000. So I'll divide this by 60,000. To express it in percentage, I multiply by 100. It will be basically 2 by 6 or 1 by 3. So it will turn out to be 33.33%. So the current tax rate is turning out to be 33.33. Yes, give the heading now. You will say computation of current tax for each quarter. Computation of current tax for each quarter. Yes, we prepare a table, we say quarter, accounting profit before tax, weighted tax rate, and finally the current tax. Just have a look at the calculation and then you may put it down. 4 quarters are there. Every quarter we know our accounting profit will be 15,000. The weighted tax rate is turning out to be 33.33%. So 15,000 I will multiply by 33.33%. 33.33% is actually nothing but 1 by 3. So 15,000 divided by 3, it turns out to be 5,000. So this is the current tax for each of the quarters. If you're still writing, you may just pause the video and complete it.
Press the bell icon on the YouTube app and never miss another update.